Welcome to the Deep Dive. You sent over quite a stack of sources today. It really reads like this perfect storm of Washington chaos, Wall Street jitters, and some really big bets on future tech.
Yeah, it's a wild mix. We've got the longest U.S. government shutdown ever, this huge push for nuclear power, specifically for AI, and then like a super granular look at real estate trends.
Right.
Yep.
So our job here is to sift through all this, pull out the crucial bits you need to know. And jumps out right away, I think, is that tension you mentioned.
Exactly. It's the stark contrast between, the immediate political mess, government shutting down, flights getting canceled, and these massive long-term investments that are just plowing ahead. Decades-long bets.
It's like two different speeds happening at once.
Totally. Short-term volatility versus long-term vision. It's kind of fascinating.
Okay, let's unpack that political logjam first, because that seems to be ground zero for the immediate chaos. 40 days starting October 1st. Yeah. That wasn't just some abstract political fight, right? It hit people hard.
Oh, absolutely. And fast. The biggest immediate hit, air travel. The FAA had to tell airlines, look, you got to cut capacity. Up to 10% by mid-November.
Why? Because of the controllers.
Yeah, air traffic controllers were working under insane stress and, crucially, without pay. We saw, 4,500 commercial flights canceled over just one weekend. It wasn't just inconvenient. People were seriously talking about safety concerns.
And the human side, I mean, missing their second paycheck. Then you had President Trump stepping in with this sort of carrot and stick approach.
Yeah, it was interesting. Threatening to dock pay for absences, but then floating the idea of $10,000 bonuses for perfect attendance during the shutdown.
Talk about pressure.
Right. Trying to manage a crisis that stemmed from the political standoff itself. And they also restricted private flights at a dozen big airports, O'Hare, JFK, LAX, just to ease the burden on the system.
Just trying to keep things from completely breaking down.
Pretty much, running on fumes and goodwill, basically.
But, okay, the sources say there's maybe a light at the end of the tunnel. The Senate passed the first step of a deal.
Yeah, first stage passed, and with pretty solid bipartisan support, actually. 52 Republicans, 8 Democrats, 1 independent.
So what's in this deal? What are the key parts?
Okay. So it funds the government, but only through January 30th. It reverses the federal layoffs, guarantees back pay that's huge for the workers.
Yeah, absolutely.
And then for millions of Americans, maybe the biggest piece, it fully funds SNAP food stamps through next September.
Now, why was SNAP such a sticking point?
Well, it short-circuits this ongoing legal fight. The Trump administration was arguing it couldn't pay full benefits because of the shutdown, but a federal judge had ordered them to pay up anyway.
Oh, okay.
So this deal basically writes that court order into the agreement, takes it off the table as a political football, and secures those benefits.
Got it. And politically, Democrats gave something up too, didn't they, on the ACA subsidies?
They did. They dropped their push for a permanent extension of the Affordable Care Act tax credits. Instead, they settled for just a guaranteed vote on it later, in December.
Which really shows how desperate everyone was to just end the shutdown.
Absolutely. It underscores how serious the situation had become. And, speaking of serious, all this political turmoil was happening right alongside some pretty weak economic numbers. Job losses in October, consumer sentiment taking a dive.
Which naturally leads to, talk about the Fed, right? Easing up on monetary policy.
Exactly. The market's definitely smelling blood in the water, or maybe smelling stimulus. Traders are now pricing in about a 67% chance the Fed cuts interest rates by 25 basis points in December.
And just quickly, for listeners maybe not tracking the Fed daily, 25 basis points, that's a 0.25% cut in the main interest rate.
That's right. It's the rate banks charge each other. It's a small cut, sort of a signal from the Fed saying, okay, we see things weakening, we're ready to help out a bit. A cautious move.
But not everyone at the Fed thinks cautious is the way to go. Fed Governor Stephen Miron was arguing for more.
Yeah, he came out saying a 50 basis point cut, double that amount, would be appropriate for December. He wants a much bigger signal.
Why the bigger move? What's his thinking?
He's basically saying the Fed needs to look further ahead, like 12 to 18 months out. Don't just react to the data we have now, which is always looking backward a bit. Try to get ahead of a potential downturn.
But isn't that riskier? Making a big cut based on what you think might happen, rather than waiting for more proof the economy is slowing.
Well, that's the perennial debate, isn't it? Miron's camp would argue the risk of doing too little, too late, and letting the economy slip into recession is actually greater than the risk of moving a bit early. He'd say the current weak data is probably just the start, and by the time it's undeniable, you've missed your chance to act effectively. It's proactive versus reactive.
Makes sense. And how are markets digesting all this uncertainty? Gold jumped.
Yeah, spot gold was up over 2%, hit $4,090 an ounce. That's a 2-week high. Classic safe haven move, driven by those rate cut hopes and just general political economic anxiety.
But then, as news of the potential shutdown deal emerged, other things moved too.
Right. Here's the interesting twist. As optimism about ending the shutdown grew, you saw money flow into riskier assets. The Australian dollar went up. Even Bitcoin surged, hit $105,060. The U.S. dollar actually weakened.
So money flowing into safety and risk at the same time.
Kind of. Gold reacting to the underlying economic worry and rate cut talk, while currencies and crypto were reacting more to the immediate relief of the political gridlock possibly ending. Different assets, different drivers.
Fascinating. Okay, let's shift gears slightly. From the big macro picture to individual stocks, Jim Cramer had an interesting take on insider buying.
Yeah, he was arguing that the really bullish signal isn't when executives buy their company's stock when it's down in the dumps.
Which is what you'd normally think, right?
Well,
Buy low.
Exactly. He says the stronger signal is when they buy heavily, even when the stock is already doing well, when it's running up.
Why is that more bullish?
He emphasizes the volume. If insiders are putting down serious money, buying lots of shares at or near highs, it signals they have really strong conviction. They don't see a pullback coming. They think it's going even higher. They're putting major skin in the game at elevated levels.
So the advice isn't necessarily chase the stock higher, but maybe.
Yeah, his advice was something like, maybe secure a small position when you see that kind of heavy insider buying at a high just to be in, but then maybe wait for a potential dip before you buy a bigger stake. Respect their confidence, but manage your own risk.
Got it. Okay, let's move to real estate now. The sources paint a picture of really different stories depending on what kind of building we're talking about.
Definitely bifurcated is the word. The NAHB's multifamily survey shows overall developer confidence is still technically negative. The index is 46. Anything below 50 is negative. But it's actually up 6 points from last year.
So improving negativity.
Sort of, yeah. But the key is where the optimism is. Developers feel pretty good about low-rise buildings, think garden apartments in the suburbs, both market rate and subsidized rentals. Those indices are above 50.
Okay, so where's the weakness then?
It's concentrated in the big stuff. Mid to high-rise buildings, and especially built-for-sale condos. You find those mainly in dense metro areas. They need a ton of upfront cash, very sensitive to interest rates. That's where confidence is really lagging.
And there's a specific market example, Clarksville, Tennessee, Kentucky.
Yeah, they use this thing called the Multifamily Market Association Index, the MAI. It basically measures how closely a local area's permitting trends match the national trend.
And the national trend has been declining, right?
Yeah, down to about 496,000 units permitted nationally in 2023-2024. And Clarksville, its correlation was 0.97.
Wow, almost perfect.
Exactly. It means Clarksville is like a mirror reflecting the national slowdown in multifamily construction permits almost perfectly. It's a useful local snapshot of the bigger picture.
Okay, now staying with housing, but looking at potential affordability fixes. This 50-year mortgage idea floated by the Trump administration.
Right. The idea is simple. Stretch the loan out longer, lower the monthly payment, and it works on paper. For a median-priced home around $415,000 at 6.3% interest, the monthly payment drops by about $233 compared to a 30-year.
That sounds appealing if you're struggling to qualify. But what's the catch? What's the real angle here?
Well, the catch for the buyer is twofold. You build equity much more slowly, and you end up paying vastly more interest to the lender over the life of the loan, like 40% more in total interest.
Ouch.
Yeah. And the bigger picture, analytically, it looks like an attempt to use financial engineering, changing loan definitions to address the underlying problems of wage stagnation and high housing costs, rather than fixing those root causes.
And it's not simple to just do this, right? It needs regulatory changes.
Big ones. It would require changing the definition of a qualified mortgage, or QM, under the Dodd-Frank Act.
Remind us, what's the QM rule, basically?
It's essentially the post-financial crisis rulebook designed to define what counts as a relatively safe standard mortgage that lenders can make without taking on excessive risks, and that borrowers can reasonably be expected to repay. Changing it is a major deal. Critics worry that making a 50-year loan a QM fundamentally redefines safe downwards and puts more risk back into the system.
Okay, so regulatory hurdles and long-term costs. It seems related, this pressure to innovate in finance, even while the government itself is trying to figure out rules for things like crypto.
Absolutely. And that brings us neatly to this other huge pressure point. The sheer energy needed for tech, specifically AI, it connects directly back to infrastructure.
So?
Energy Secretary Chris Wright just announced that nuclear power is going to get the lion's share of the Energy Department's loan money going forward.
And the reason is explicitly AI.
Explicitly. It's to meet the absolutely massive electricity demand expected from all the new AI data centers being built by Google, Amazon, Meta, Microsoft, all the big players.
This is a huge strategic shift. What kind of money are we talking?
It's enormous. The administration finalized an $80 billion deal with Westinghouse's owners to build new nuclear plants across the country. This is a fundamental bet on needing huge amounts of reliable, 247 domestic power.
Baseload power, right, the kind that's always on.
Exactly. AI doesn't sleep. And right now, nuclear is really the only mature carbon-free technology that can provide that kind of dense, constant power at scale without relying on weather like wind or solar.
And while they're trying to build the power plants, the AI hardware itself is also racing ahead. There's this new startup, Majestic Labs.
Yeah, founded by some heavy hitters, ex-Google and Meta chip execs. They just raised $100 million. And they're not just trying to make incrementally faster processors.
Their angle?
They're tackling the memory bottleneck. Their patent is for a new server architecture designed specifically for AI workloads that need huge amounts of memory close at hand. Basically, a lot of AI is limited by how fast it can access data, not just how fast it can compute.
So better memory access, what does that mean in practice?
They claim, and it's a big claim, that one of their new servers could potentially do the work of up to 10 of today's top-tier server racks.
Wow, that's a massive leap in efficiency, which also ties back to power and cooling demands, right?
Absolutely. If they can deliver, it tackles the compute and the physical constraints, space, power, cooling of scaling AI. It could be a game changer.
Okay, from cutting-edge servers to TNT. There's a shortage.
Yeah. Seems random, but it connects everything. The war in Ukraine is driving a global shortage of commercial-grade TNT.
Which isn't just for military use.
Nope. It's essential for mining, construction, energy production, basically anything that involves moving large amounts of rock or earth.
Okay, so why should you, the listener, care about a TNT shortage?
Because the price has gone through the roof. From maybe 50 cents a pound in the early 2000s to like $20 a pound now.
$20 a pound.
Yeah. And you need that explosive to get the raw materials, the aggregates, the minerals that go into concrete, asphalt roads, building foundations, even the components in your phone.
So the cost of this TNT shortage gets baked into the price of almost everything physical.
Pretty much. It's a hidden cost driver fueled by geopolitics, hitting everything from infrastructure projects to the cost of a new house.
Is there a fix coming?
Domestically, yes, but slowly. The first new U.S. TNT plant since the 80s is being built in Kentucky, but it won't be online until 2028.
So years of these higher costs are likely locked in.
Looks that way. Minimum 4 more years, probably.
Okay, shifting to global trade, a slightly more positive note. China suspended some export restrictions.
Yeah, following talks between President Xi and President Trump, China eased up on restrictions for several critical minerals, rare earths, lithium battery stuff, gallium, germanium.
Things needed for tech and green energy.
Exactly. Seems like a move to kind of lower the temperature a bit on those specific supply chain friction points, a tactical de-escalation.
And finally, on the global corporate front, Burger King is making a huge bet on China.
Massive bet. Restaurant Brands International, BK's parent company, is teaming up with a Chinese asset manager, CPE. They're investing $350 million.
And the goal?
To more than double the number of Burger Kings in China. They want over 4,000 locations by 2035.
Wow. Despite all the geopolitical noise, that's a huge, long-term commitment to the Chinese consumer market.
It really is. A pure 12-year bet that the Chinese middle class will keep growing and keep spending. Shows that global business calculus often operates on a different track than diplomacy.
Okay, let's try and pull this all together. We've gone from a 40-day shutdown that finally seems to be ending, all the way to the specific price of TNT impacting construction globally.
And that collision we talked about at the start is really clear, isn't it? You have the immediate political crisis, the shutdown, literally stopping Congress from working on things like rules for crypto, like the Clarity Act.
Right, because they were just trying to keep the lights on.
Exactly. But at the very same time, you have federal agencies like the FHFA telling Fannie Mae and Freddie Mac, hey, start looking into how you could use crypto assets when underwriting mortgages. Possibly even these new 50-year mortgages.
It's a huge disconnect.
Yeah.
Policy is stuck in neutral, while market innovation and institutional interest are hitting the accelerator.
That gap is massive, and it perfectly sets up our final thought for you to chew on.
Okay, what should listeners be thinking about?
So this political deal to end the shutdown means official economic data, like the crucial jobs report. Non-farm payrolls should start flowing again soon. Right now, the market thinks there's a 67% chance of that small 25 basis point rate cut in December based on the limited data we have.
Right.
But what if that official data, once it finally comes out, is much, much weaker than people currently expect? We already saw those weak signals in October jobs and consumer sentiment.
So if the official numbers confirm a sharper slowdown?
Exactly. How quickly could that 67% chance of a small cut morph into near certainty of a bigger 50 basis point cut like Governor Miron was suggesting? And, maybe more importantly, what would that sudden shift in rate expectations do to that already fragile part of the real estate market? The mid to high-rise construction sector that we saw is already showing major weakness.
So the return of data could really shake things up quickly, especially for interest rate-sensitive sectors that are already stressed.
Something to definitely keep an eye on as Washington hopefully gets back to actually governing.